Hello. First of all, let me express my gratitude for being invited to this conference of digital economy. In particular, well, they told me to speak on the topic of the tax challenges of sharing economy. And for this purpose, I'm going to I will divide my speech in three parts. Well, briefly, I will start with the delimitation of the concept of sharing economy. As is known nowadays, there is no a uniform, a common definition of what sharing economy, of what collaborative economy is, given the ideological substratum, of the ideological background that is present, that is inherent when we refer to this new reality of digital economy or digital business in the 21st century. So, in this context, we must first specify what we mean when we talk about sharing economy, collaborative economy. And once we have clarified the reality to which we refer, the second part of my speech regards the tax challenges of platform users, and the third part is going to be focused on the tax challenges of digital platforms. In relation with platform users, we will see how a new income earned by individuals appears, and with this new income, on the one hand, we are going to see problems to evaluate, to determine if and how this income should be taxed, and on the other hand, we're going to see as well, we are going to highlight the new opportunities for public authorities, for the legislator to regulate this income. And finally, in relation to the platforms, we will highlight on the one hand the new developments in the collaboration of platforms with the tax administration, and on the other hand the problem of taxation. Well, better said, the non-taxation of these technological platforms in the jurisdictions where they carry out their activity, where they really operate, but they don't have their tax residence. Well, as we have said, the reality in which we are focusing is the collaborative economy. What is sharing economy? What is collaborative economy? Well, understood in a broad, in a wide sense, collaborative economy is identified with platform economy, with platform business. This is the position, for example, of the European Commission, which since 2016 understands by sharing economy any business model through platforms. In this includes B2B, B2C, C2C. However, understood, if we understand this term in a narrow, in a strict sense, the businesses considered as collaborative economy are those in which the users of the platforms, they don't act within the framework of an economic activity. Users are individuals who deliver, who offer goods and provide services for the purpose of sharing, exchanging, but not for the purpose of carrying out an activity, an economic activity. This would be, for example, the position of the European Economic and Social Committee, which in 2014 defined it as the traditional way of sharing, exchanging, lending, renting, and regulated, but redefined through the modern technology communities. Well, in our view, if we have to take a position, we are closer to these authors that point out, that define the business platform as a whole, and the sharing economy as a type of business platforms where users, they don't act in an economic activity framework. Users who are identified as everybody knows prosumers, individuals who are producers and consumers at the same time. Well, in any case, as well as we will show next, from the tax point of view, the truth is that it doesn't matter if we are in a wide sense or in a short term, no? Because the truth is that from the tax point of view, in relation to users, the great novelty, the great change is, from a tax point of view, is in the collaborative economy in a strict sense, no, in this prosumers field, no. But however, as regards the platforms, the tax challenges reach all of them without distinction of the type of business. No, therefore reach all the platforms business, all the technological big companies. Going into the tax challenge of users, one of the big questions in tax matters is whether income earned in collaborative contexts should be subject to tax, to income tax. Um, these revenues in the collaborative context are not new. What is new is that they are now obtained through technological platforms that delivers the supplies of goods and services between individuals with the purpose of obtaining an economic profit within the framework of an economic activity have always existed. But with the startups, the collaborative consumption acquires a global dimension, no? It becomes a global phenomenon. And in this context, from a tax point of view, we are dealing now with revenues that, on the one hand, have increased substantially, and on the other hand, and more importantly, it's possible to control them by the tax administrations because the platforms can provide this information to the tax authorities. In short, we are dealing with revenues that until now were not significant and moreover couldn't be controlled by the tax administration, by tax authorities. Let's think, for example, of private or individual lessons, of the sale of second-hand goods between individuals, or even the renting of a room or a house. Over the years, this collaborative consumption have not been reported to the tax authorities, and these administrations, these tax authorities, they couldn't control them, this income. No? Now they can be important incomes, and furthermore, this income can be controlled by the tax administration, the tax authorities. Well, with this new reality, this income obtained in collaborative context that can be controlled by the tax administration, the second issue is to apply taxes correctly. Taxes are not designed, income tax at least is not designed for this type of income. As a result, in some cases, it's now easy to determine whether the income should be taxed, and in other cases, the difficult lies in how to tax it. There are many problems of interpretation, qualification, and even quantification. Let's think, for example, income with the only intention of sharing economy. This would be the case, for example, of the income of the BlaBlaCar driver, no? The income theoretically to cover the cost of the trip. Some authors understand that here there is no economic capacity to pay tax, to be subject to tax, but we have another author that they consider that above a certain threshold there is economic capacity and they should be subject to tax. The problem in these cases is how to define most of the time this type of income and how to quantify it. Similar questions arise in the exchange of services, the home swaps, for example, or in the occasional income obtained from the transfer of the use of the property or from supply sporadic services with the purpose of covering the cost of the ownership. Let's think, for example, of sending a package, you know, in a private car when I travel to another city, no, or when I rent my car just three weekends a year. In this context, the third question arises for the public authorities, for the legislator. First of all, do we leave the regulation of taxes as it is now. For the moment, this is a Spanish position, and we have to say that many aspects that are problematic in this way should be clarified by tax administrations, and by now they are not doing it. If we continue in this way, it will be the tax administration or the administration and the case law that will clarify this role, no? To understand. Well, a second question could be that the legislator could take a step forward and introduce some specific changes to the tax. These changes can be uh, designed to define, to ring fence collaborative income, no? And apply a special measure. For example, United Kingdom have regulated an exemption for the rental of a room in a permanent residence until £7,000, for example, is exempted. Or Denmark, since 2017, first of all, has created like a website to provide quick answers to quick answers on questions related to the collaborative economy, and has established an exemption for rental housing in euros is more or less like 4,800, but under the condition that the rental is made through a platform that provides the information to the tax office. France as well has regulated this fiber is a kind of self-business. It's people who carry out complementary jobs through platforms such as Airbnb, Uber, BlaBlaCar, childcare, Elcare, elderly care, or private lessons. No? For the income that they obtain from these complementary works, jobs, from this in this collaborative context, they have established, the legislator, the French legislator, they have ruled a simplification of taxation. For example, they are not subject to tax, to value add tax, and every trimester, every 3 months, they pay a percentage, an average of the volume of all this income for income tax, without taking care of the qualification or quantification that would take place in the traditional system. Belgium, for example, has a rule at 10%, I think up to 5,000 of income from services provided through platforms. But anyway, it doesn't apply. Only it applies to services through platforms, but not to sales or rental. And finally, other countries are being more ambitious and are working in order to rule a different, or better said, a new category of income in relation to collaborative context. China, for example, is looking at the possibility of taxing at 10% all the income earned through platforms. And well, Italy developed in 2016 a new category of income. The income, well, the translation I think would be like income from non-professional share economy activity. With this proposal, they tax all the income at the 10%, but the truth is that so far has not been approved. But the truth is that it's been a reference. This project, this proposal, has been is being a reference of a study by many countries. To conclude with the tax challenges of platform users, it's important to point out the work of the OECD and the European Union on the regulation that they are working now at the European community and an international level of the obligation of platforms to provide information on users' income and transactions. In particular, this regulation consists of an obligation at the domestic level, at the national level, and another at the international level. At the domestic level, the platforms provide information to tax authorities of the country where they are residents for tax purpose, and later, at the international level, there is an automatic exchange of information between all the tax administrations, in particular the tax administration of the country of residence of the platforms supplies the information to the tax administrations of the countries of residence of the users of the platforms. For example, in the case of Airbnb, the platform is resident in Ireland. According to this new standard of reporting, first, the Airbnb platform will periodically provide all the economic information about the properties and users to the Irish tax administration. And then this Irish tax administration will periodically and automatically provide information, for example, to the Spanish tax administration about the property rented in Spain and the users that receive the income. So, in soon, I think sooner rather than later, tax administrations will have all the information periodically regarding all the economic transactions and all the income of taxable individuals in their territories. And in this sense, in my opinion, from that moment on, the legislator will be aware that he has to introduce changes in the income tax and in other taxes as well, in order to simplify the taxation. We have to think, for example, when it's going to be really common that individuals they obtain, for example, an annual income of 7,000 euros obtained from different services and deliveries of goods through several collaborative platforms. No? The 7,000 is nowadays is really complicated, and at the end you don't have to pay taxes. So I think they would have to introduce many changes in order to simplify these situations, in order to correct tax. Well, and last but not least, as I said at the beginning of my speech, the last part is focused on the challenges of technological platforms. On the one hand, technological platforms are emerging as the new protagonists in terms of collaboration within tax administrations, collaboration in providing information about the users, and collaboration in collecting taxes from users. And on the other hand, the huge challenge about platforms is the taxation in the countries where they operate. As is well known, the technological corporations pay little or nothing for corporate income tax. And this is because the international rules are obsolete, as we are going to see. And in this regard, I will explain what developments we currently have. Regarding the challenge of collaboration from platforms to the tax administration in providing information about the users, we have to realize that platforms keep in their possession all the economic information of their users. And in this sense, it's crucial, it's really important to regulate obligations of the platforms to provide information to the tax administration, reporting obligations. Currently, some states unilaterally have regulated this type of reporting obligations and uh, are usually made for certain platforms. For example, Spain in 2018 approved the informative disclosure and the rental of tourist accommodation. This obligation is obviously designed to ensure, to make that platforms such as Airbnb provide information on the real estate or on property rented in Spain. However, this obligation, we have to say that involve many legal problems. For example, how to enforce, how to impose a non-resident entity in Spain, such as Airbnb, to provide information. And well, if we want to see an example, according to this obligation, which applies currently in countries like Spain, in this illustration we can see how it works. Now, Airbnb is a resident in Ireland, and it's obligated, it's compelled to provide to the Spanish tax administration periodically all the economic transactions and owners related to real estate located in Spain. Anyway, in the near future, as I have mentioned before, will be mandatory for most of the platforms the supply of all the economic information that these platforms have about the users. And it's so important. We have to think that it's so important for the tax administration to have access to the economic information from users of platforms that since 2020, as we have mentioned before, the OCDE and the European Union have been working on the establishment of an international standard for the provision of information by digital platforms. Following this example, for example, of Airbnb platform, first at the domestic level, as here you can see in the jurisdiction where the platform is resident, there will be an obligation to provide general information about users to the tax administration, in this case to the Irish tax administration. And secondly, at the international level, this Irish tax administration will automatically and periodically provide this information to the other tax administrations of jurisdictions where the users have to pay taxes on their income. But in relation to collaboration of the platforms with the tax administration, another challenge, there is already progress, and without any doubt, there will be more progress in the near future, is the collaboration of the platforms in collecting the taxes that users must pay. Uh, the collaboration implies that for each economic transaction, the platforms collect the tax payable by the users, and deliver this collection to the corresponding tax administration. This collaborative, if we think in terms of negative or positive, this is very positive for the tax administrations because, of course, it ensures that taxation of income obtained through platforms and ensures this taxation, and of course saves as well costs in the control of the compliance of users' taxes. If we think in positive ways, I think it's also positive for the users because it is the platform that who declares and reports the taxes. However, if we think in positive or negative way, I think it's a great cost for platforms. It's not so positive because for them it's a great cost to assume the collection of taxes, and of course they are very resistant to comply this type of obligation. Anyway, currently we have some regulatory examples already, but there is still a long way to go because legally it's not easy to establish this this type of obligations for non-resident platforms in our territories. In this sense, as with the obligations to provide information, as we have said before, in relation to reporting obligations, it's necessary an action from supranational institutions such as OCDE or the European community. In order to regulate this type of obligations, there are two crucial issues, two significant issues. First, is determine which taxes should be collected by platforms. No? The most regulated at the moment is the tax for tourist stays. Italy, for example, since 2017 has ruled the obligations of platforms like Airbnb to collect this tax. And in Spain, in Catalonia, the platforms also collaborate in the collection of the Catalan tax on tourist stays. Another tax could be, of course, the value add tax or income tax. About income tax, Belgium has regulated the obligations of the platforms as a withholder of the 10% of income from services provided through platforms. And well, and finally, the second important issue, which is directly related to the previous one, is what specific subjective position does the platform occupy in the collaboration of collection? A substitute for the taxpayer, withholder, or just a simple collaborator in the collection, no? Because the legal configuration of this position is very important in order to establish what rights or what obligations the platform has with respect to these taxes. Well, in Zoom, in this current context, I think sooner rather than later we are going to see many developments in this field of collaboration. Well, to conclude my speech, I will make a brief reference to the last and most important challenge of all: how to make technological corporations to pay corporate tax, corporate income tax, and in particular, how to make them pay a tax in the states where they have a large activity, where they carry out their activity, but they don't have a physical presence. Well, first of all, we have to ask ourselves, where is the problem of this situation of non-taxation or low taxation of technological corporation? Where is the problem? Um, International rules, first of all, international rules as a state, has confirmed the OECD and the European Union are obsoleted, are outdated. They are made for a context in which companies have their physical presence in the place where they operate and where they carry out their activities and they earn their business profits. No? And taking into account this situation, the international rules follow a personalistic criterion on physical presence. The corporate profits must be taxed exclusively in the states where the company has a physical presence, subsidiaries, or you have a permanent establishment. Specifically, in particular, this is set out in the Article 7 of the Double Taxation Conventions, DTC, which establishes that corporate profits are taxed exclusively in the country where it has a significant physical presence. Normally, this means a state of the tax residence of the company or a state where you have what we call in taxation a permanent establishment, a fixed place where you carry out your activity. Within this legal framework, large what the companies what they have done, especially technology companies, they establish the tax residence, of course, in low tax countries, and they carry out their activities without the physical presence of the company in many other countries. They are now it's different. The country where they have their physical presence, where they have their residence or their establishment permanent, and the other countries where they carry out the activity. And this is the new reality, that there is disconnection. This is no connection. Sorry about these two kind of countries. And as a consequence, um, the multinationals pay little or nothing for corporate income tax at a global level, and the source of states, the states where the activity is carried out, where the activity takes places, these states cannot tax the profits the platforms have earned in their territories. Activities such as transportation, like Uber, accommodation, Airbnb, or advertisement in the case of Google. So all these activities that they carry out in our territories, we cannot tax them because they don't have their residence here or they don't have an established permanent establishment. The rules they are done for another time. Well, let's take a look now in the next page. Let's take a look of an example of the tax planning used by the technology companies and how we are going to see how they manage to pay practically nothing for corporate income tax simply by using the international and domestic rules. Everything is totally legal, as you're going to see now. Well, to understand why technology corporations don't pay income tax in the source states in the states where they carry out their activity, let's look at an example of the tax planning used in concrete by Uber. Explained, and this is, example is explained by Fortune magazine. Well, the company Uber uses the so-called Dutch sandwich or the double Dutch. Often used also this expression double Dutch sandwich is often used as well by other technological companies such as Airbnb, Facebook, Google, etc. And this structure that we are going to see of Dutch sandwich of double Dutch is has always the same purpose: is transferring profits to low tax jurisdictions, and of course not paying taxes in the countries where they really operate and where they make profits. Here, as you can see, Uber we begin. It's an application. It's created by Travis Kalanick in 2011 in Silicon Valley, San Francisco, California, which is Uber Technologies. When he realizes the expansion that he's going to have worldwide, he designs a tax planning so that the profits obtained in the rest of the countries pay very little corporate tax. In order to do so, it first creates a company in Netherlands, but with its registered office in Bermuda, Uber International CVU, and transfers the exploitation of the industrial property, the Uber application, outside of the USA to this company. So this company now is the owner, it holds the exploitation, the rights to exploit the application, Uber application, outside of USA. To do so, as you can see here, they make cost sharing agreement to share costs and benefits in the development of the application. Now, these two companies, they share the cost and the sharing and the benefits of in the development of this this application. The Bermuda company pays for this, according to this agreement, 1 million and an annual royalty of 1.45% of the profits obtained outside USA. That he gets that that of all the profits obtained outside the US, only 1.45% is going to be taxed in USA. Secondly, he creates a company in the Netherlands, Uber International Holding. This company signed a license agreement by which the Bermuda company gives to the Netherlands company the exploitation of the business outside the USA in exchange for an annual royalty of 99% of all the profit that this company obtains. It ensures that 99% of all profits earned outside the US are taxed in Bermuda, that at the end is taxed at 0%. That is, it ensures that 99% of profits are not taxed at all. And once it has this structure, the Dutch sandwich or the double Dutch, at the end they are just two companies. Uh, the company, he creates the companies that Uber creates in the countries where the transportation, the activity takes place. Here, all these subsidiaries, Uber subsidiaries, maybe have 60, 70. Um, Around the world, and they are in jurisdiction that they have to pay a normal corporate tax. But what they do is that these companies that Uber creates in these countries where the transportation, where the activity takes place, the source state, the market state, these companies they don't receive profits at all, and anyway they have expenses. They always do that. The base, the income taxable is always reduced by making many expenses that these companies they have to pay to the company in Holland, interest, services, etc. So all the small benefit that maybe they could have in the market jurisdictions goes as well via through expenses to Netherlands. Okay. Consequently, in these countries, in the marketplaces, in the market jurisdictions where the activity takes place, Uber doesn't pay corporate income tax at all on the profits that it makes from transportation in all these territories. In short, as you can see here, uh, the 10% of the payments to Uber for using the application, 10% of this benefit go to the company in Holland. Indeed, you can see always the bill when you use Uber. When you use Uber, you will see in the bill how you are paying always to this company in Holland. So all the benefit, all when we pay Uber, goes to this company in Holland, 10%. And from Holland, 99% goes to Bermuda. So in the state where the activity is located, they don't pay anything. If we see the three states, in the marketplaces, in the market jurisdictions where they have the activity, they don't pay anything for for the profit of the Uber application. In Holland, just only 1% of the profits are taxed in Holland at the 25%, but it's 1% of the profit which is taxed, and in Bermuda is not taxed at all. So everything is legal, and this is more or less, as you can see, it's really easy to do it. This double Dutch or the Dutch sandwich. There are two companies, and one always is in a tax heaven that at the end is going to pay corporate tax, and all the benefit go there. No? This is the base erosion of the corporate tax and profit shifting, and you take this benefit to the jurisdiction with no corporate tax at all. And as I say, everything is legal, my friends. Well, given the situation of lack of taxation in the states where technological corporate operates, I will end my presentation by pointing out a brief description of what has happened and what has been done. As we are going to see, not too much. First of all, the OECD in 2013 elaborated a 15 action plan to fight BEPS, to fight the BEPS phenomenon, base erosion and profit shifting. That is, to fight against corporation tax planning that artificially reduce the taxable income of corporate taxation through the transference, through the shifting of this taxable income to low tax jurisdictions. And in this, within this action plan, the action one focused on the challenge of taxation of the digital economy, how to achieve taxation in states where they have no physical presence but significant activity. After 2 years of work, a report was published in 2015 in relation to Action 1, and they were saying that there could be three possible solutions and they formulate three possible solutions to allow source states to tax profits. For example, a new definition of digital permanent establishment. This means like a permanent establishment with significant presence, but not physical presence. Another solution would be like a withholding tax on income, or another solution like specific taxes on volume of income. However, the report concluded that there was no consensus about a specific solution, and that work would continue on it. 3 years later, in 2018, another report is published, and which focus now on just in one solution, the solution of the digital permanent establishment, and to include this new definition in Article 7 of the Convention. But also, this report concludes that there is no consensus, and that the agreement has to be postponed to 2020. Then comes the unilateral states' reaction. In view of the failing of the OECD Action 1, many states such as India, United Kingdom, Uruguay, Peru are began to regulate unilateral measures to tax the profits that technologies companies make in their territories. Taxes on certain digital services, also known as the Google taxes. No? Even the European Union in 2018, after the OECD report of 2018, made a proposal for a directive to implement a digital service tax in the European Union. And Spain, for example, has also approved in 2020 the tax on certain digital services that begins, by the way, to apply this July 2021. This what implies this new tax. These taxes, these digital services taxes, involve that the states where the users are located, where the users of the platforms are located, users of advertisement, of the accommodation, of the transport, etc. These states, they tax a percentage, an average of the income obtained by the platforms in their territories. For example, the digital services of Spain is 3%. So at the end, what is going to happen? What will happen in the near future? Quo vadis? The truth is that OECD doesn't want that the states adopt unilateral taxes on digital services. And in this regard, since 2019, it has changed its policy, and now it's working in something that maybe there is a consensus, and they call it they call the Pillar 1 unified approach, and the Pillar 2 the global proposal. What is Pillar 1? Pillar 1 tries to provide a new solution to Action 1, to the taxation of digital companies in the state of the source. The solution would be to tax some of the profits of some of the large technology companies in market jurisdictions. So maybe some market jurisdictions, some source states, maybe they're going to have some right to tax. This solution anyway has many critics, because the system to do this is quite complicated. In addition, countries like Spain don't seem that we are going to collect much with this solution. And moreover, if we assume this new system, the states that we assume this new system, we have to eliminate the unilateral taxes that we have already approved, the digital services taxes that we have already approved and we are collecting. So it's been has many critics, this system anyway. And finally, Pillar 2, global proposal, aims theoretically to ensure that multinationals, multinationals as a whole, pay a global minimum corporate tax by reducing using the tax competition between states. Here is the famous measure of 15% minimum for corporate taxation that we have all heard in the media. Unfortunately, I'm sorry to tell you that this proposal of a minimum fee of 15% corporate income tax doesn't mean that the whole company is going to be taxed with a rate of 15%, and that this collection of 15% of the whole company is going to be distributed between the states where operates the company, as would be the logical and would be fair. This measure, indeed, and unfortunately, consists of allowing certain states to tax corporate income when the tax that these companies already have paid in the state with the right to do it is lower than 15%. I mean, it's an instrument that in practice can be used just for by few states, and it's very complicated. Which states they are going to apply these measures to tax a little bit until the 15%? Rich countries such as the G7 countries, which are clearly capital exporters. It's not countries like Latin America or countries like Spain. With the 15% measure, not all countries gain, and it's not a equal measure. Only few countries they are going to gain with this measure, and Spain, for example, for sure, is not one of them. In any case, and in this is really my last point. This July, 2021, takes place the international meeting where we will be told whether there is agreement on Pillar 1, or there is agreement on Pillar 2, or maybe, I don't think so, but maybe could be as well consensus on Pillar 1 and Pillar 2. So I hope you enjoy my speech. And if you have any question, please don't hesitate to contact me. Here you have my email. And thank you very much.